Hello, everyone. Hello, sir. Welcome back to a new episode of Decoding Markets in Three Moves.
Pleasure
And
to be back.
welcome, everyone, over here. So, here in Decoding Markets, we will decode every movement of the market. It's not a fluff, it's actually a technical thing that everyone should know. So, let's get tuned and let's proceed further. So, hello, sir. It's a midweek. So the market for the week was not much thing. It was going same decline. So we can see today also that the market is going sideways. So what's your review on that?
Well, is the interesting thing. I'll start this time with sharing my screen because we've been doing less and less of that, and I'll use strike come to Nifty and simply show you the chart screen where automatically when you come to the charts you end up seeing what we call as the trade setup. So that's a very good starting point for everybody because what you see on this is not just the indicators and all plotted on the right hand side, but they're reading on the right hand side. Okay, so that's a very important part. And what you will immediately notice is that we are seeing a buy reading here on the Nifty RMI. This signal is now 3 days old. So you got the new buy signal on the 11th. Okay, that is Monday. It continued to be there yesterday, even when the market went down. And now it continues to be there today. And this is coming after a prolonged period of time, right? So the new sell signal actually showed up on the 4th of July. And since the 4th of July, the RMI has been in sell mode. So now it is turned to bullish. So this is an important turn. So while you may say that, yes, markets have been sort of flattish because they're at the bottom end of the range, the downward momentum is somewhere changing. That is what the RMI is showing. Okay. The next thing that we look for is, do we start making a higher high, higher low kind of pattern? There are two ways to see it. One is in terms of highs and lows, and one is on a closing basis. Now, what you see here is the Dow trend reversal, which is essentially on closing basis, which works when you look at a line charts. On a line chart, when we actually see prices starting to move up, which is make a higher high and a higher low structure, that's where it recognizes that the trend may have changed from down to up. So this also has changed after some time. There was a slight change here for a day, but it did not last. Okay, so this was around the 23rd of July, which is up here. So it did try to go up, failed. Again, it's trying to go up. But when we see it on a bar chart, we may not have closed above yesterday's high, which has not happened. But fine, that could be the next thing that we'll actually look out for. But we'll also look out for getting above the 20 DMA because throughout this fall, we've remained below the 20 DMA. So that's the immediate hurdle. And that level is around 24781. So, sorry, not 24781, 24. Is that it? 24. What is this? Yeah, 781 is correct. Yeah. So above 24781, we'll have crossed the 20-day average as well. So one by one, as increasing number of data points show that the trend is changing from down to up, we are going to try and anticipate how far can this go. The easy part is look for the next swing high. There's one swing high here, and there's the next one which is here. Each of these will be levels that we will go and contend with. The first is closer to 25,000 and the second is closer to 25,250, and those are going to be the next 2 points. So I've sort of broadly given away the view that we see here using the RMI and using classic Dow theory without getting into the Elliott wave analysis of it. And what we've actually seen this time also is significant divergences on sentiment indicators. We have not seen anything like this in a long time. So usually sentiment gets oversold and the market bottoms and bounces back when the trend up is very strong. Multi-day or divergences like this are very rare. Okay, I've tried to go back and check when did it last happen, and it's very hard to find except for one example in a year or in 2-3 years. Sometimes you hardly find an example of something like this, and therefore it's very hard to predict that it will happen. Sometimes markets continue to fall till you get another oversold reading. That did not happen here so far. and we've actually seen the positive divergence in the swing, not just the swing. Even if we look at the percentage of RMI buy indicator on the diffusion, same pattern. Essentially, what it's showing is that momentum in individual stocks started to improve much before the index itself. So that has been happening since probably the end of July, but it was not reflecting in the Nifty, which continued to fall, possibly because of some of the more affected sectors by the entire tariff theory, like the IT sector, and maybe some of the other large caps that are in the oil space, for example, that were impacted by it. And but there are companies that have delivered numbers and that are expected to do well given the trajectory of interest rates, and they have actually held out. Two of them, namely being the autos and metals. If we just look at the 1 month performance, the two top performing sectors are auto and metal, apart from the defensive FMCG pharma. So I sort of rounded up. You asked me a short question, but I've rounded up my thoughts here, for people to quickly get an idea of what has happened. The downward momentum has finally changed a bit. You might want some more proof, which you might get tomorrow. But there were too many positive divergences and too many readings in the near term that were not playing out.
Yes,
Uh,
sir.
but they are doing so just after we broke that shelf support, right? It was at around 24,500 or 450. There was a multiple supports were being made. Moment we broke that support, the market seems to be reversing. So it's like a shakeout, right? You break the last swing low, everybody gets nervous, and then it turns from there. That is sort of the pattern we are seeing here. Let's hope that we get further confirmation of this upward momentum tomorrow by getting past yesterday's high, which is 26,640. That would no, that is the interim high. That's not even yesterday's high. So what was yesterday's high? Yesterday's high is 24,702. So let's see. That's going to be the next thing.
So moving forward, what is the interplay between time frames and fractals?
They're two completely different things. I can't say that time is a fractal, not gone that far, but price definitely is a fractal, meaning that we see repetitive patterns. The moment we say that a pattern repeats itself and it does so consistently, then we are close to saying it's a fractal. And Elliott wave theory sort of defined that fractal in terms of waves, right? That market moves in the direction of the main wave in 5 waves and against it in 3 waves. So that pretty much enforced the idea that there's a fractal in markets, and this 5-3 structure repeats itself over and over again, not just one after the other, but also at lower and higher time frames. So the same 5-3, 5-3, 5 at a lower time frame is a larger 5-3 on a higher time frame, and so on and so forth. So markets are fractal as far as Elliott wave analysis is concerned. But Elliott wave analysis doesn't take time into consideration. We can do Fibonacci calculations on price. Some time analysis has been attempted on time, most of which I have seen to fail, most of which I've seen not give you results. Therefore, I don't spend time on time analysis. Though some kinds of simple time analysis are useful. For example, seasonality. Which month are we doing well or which month we are doing badly? Because sometimes seasonal effects are there. There's a reason why, because of your annual budget is every year in Feb, so there's a different type of sentiment around February. And then because FIIs bring in new money post Jan, there's a different kind of sentiment between December and Jan. And also because the new year starts in India, there's the result season. So you have a kind of behavior between May, June, and May is basically the first or second month after the new financial year starts in India. So different months that have particular kind of behaviors. This year we saw an inversion where July, which was the best performing month of the last 4 to 5 years, ended up being the worst performing month. So that also happens. Another kind of time analysis that is useful is knowing how many weeks or days a certain pattern takes. So sometimes you get corrections that are 2 to 3 weeks long. So then you'll find that every correction is 2 to 3 weeks long. Now this is a generalization. It doesn't mean that you can't suddenly get a 5-week correction. We just got the longest losing streak in I don't know how many years recently. I mean, the most recent sell-off in the market, I think it lasted for 6 or 7. 1, 2, 3, 4, 5, 3, 6. Yeah, 6 weeks. So 6 weeks is a pretty long streak. You'll have to go back several years to really find a 6 week losing streak. But that's another kind of time analysis. So like I said, it's useful but not absolutely accurate. uh, but price analysis can be more exacting in terms of ratios, in terms of the structure that you're expecting going forward.
So my next question to you, if everyone says that stock always go up in the long run, okay, market always go up, does that mean that best strategy is to just buy the stock and do nothing and forget it for a long period of time?
So to some extent, the answer is yes, except that buy a stock or any stock is not the answer. It has to be a specific stock, because when you make the statement that markets always go up in the long term, we are saying markets, and by markets we really mean an index, the Nifty 50, the Nifty 500, and so on. But what ends up happening within the components of the Nifty 50 is that many of them get changed over time. One, two, the weightages also of each of the components keeps on changing. So these two factors mean they are based on the idea that the same stocks may not remain blue chips forever. If they are not, they are removed and new ones are brought in. So the index always ends up having growth stocks embedded inside it, and you have to therefore adjust your portfolio towards an index. So therefore, if the answer is yeah, buy the index, invest in an index fund and just forget about it, that can work. It's called passive investing. A lot of people do it, but active investing is more bottom up in nature, where you invest in stocks that are likely to be the best performers of the current phase. And the object of that is really to outperform the index and do much better in terms of returns. So now there also you can argue that these stocks will do well forever, but sometimes individual stocks can go through a growth phase where 5 years, 10 years they do exceedingly well, and then after that they can actually hit a wall. Now, whether they'll be able to extend that growth cycle into a new one is often unknown. So you have to then just enjoy the returns of that period and actually get out at some point of time. But for most large caps, which are well known industrial companies, whether they're in sectors like power, steel, and so on, they've survived over time, and if you hold on to them long enough, yeah, they'll keep giving returns. But they also go through their what do you call business cycles, where for 5 years, 6 years, sometimes they underperform the market. So again, it takes us back to the central point that the market is not the stock. The market is a combination of stocks, which is an index in which something or the other is always performing, and therefore the index always gives you always goes up in the long term. That is the thing to keep in mind.
So keeping in mind, moving to the last question for today's episode is, using RRG, can we find stocks or sectors which are showing the strongest sign of outperforming the market?
So I'll quickly go to the RRG tool. It essentially involves 4 different quadrants in which we are trying to judge the whole thing. And just one second. Yeah. So the RRG chart, shows you all the sectors. You can either choose all of them, or you can choose some of them. But what you're really trying to figure out is stocks that are, moving from the left hand side to the right hand side, or moving up in a diagonal pattern from one side to this. So either trying to move up this way, and those are the ones you want to see. Even if it is falling down from the leading, if it turns around, and starts to move back up into the leading segment, or it turns around and starts trying to go back up from the improving to the leading, that is also considered. So anything which is moving from the left bottom corner to the top right hand corner can involve a segment that might outperform or start performing from an underperforming state, and that is what you want to really search for. So it's not just about going and finding the segments in leading. That's very easy, right? We are color coded all the greens over here, but also the direction in which this is moving. Now, what is this? Some people might say, yeah, it looks like some snail or some kind of a snake. It's essentially the point at which that particular sector is. Let me just take the example of metals, which is one of the outperforming sectors. See, what you see in the metal sector is that the arrow here is the latest data point, but this is what we call as a tail, which is the last 7 8 data points, and this is actually 10. So you can choose how many past data points you want. You can reduce it, okay, or you can increase it, just so that you want to get an idea from where it's coming and where it's going. Now, in the case of metals, you can see that it was a leading sector a month back. It started to drop or weaken. That's because the market was falling. But as it got here, it's turning around and going up in a right angle direction, which is in this particular direction. This is a very strong sign that it can go from weakening back to leading in a week or two if it continues in that direction. So you want to look for stocks that are actually turning back this way and continue to go in that direction towards the leading side. That means they would again become an outperforming segment. So that is what we search for, looking at where it is, where it's going. Now, if it continued to fall and it's going into the lagging zone, then you definitely don't want to own it at that point of time. You want to start owning it or increase your weightage to the sector when it starts turning up and heading towards the leading segment. And like I said, at a 45-degree angle from the left to the right is the ideal progression for any sector.
Got it, sir.
If people want, they can actually, see the entire tail by simply dragging this. It's a very beautiful tool created by Dick Kempner, and yeah, that's what it does. So you just end up seeing it, and if you want to play it, you simply press play and it'll play the entire rotation for you. You know how it has behaved over time. So you see it started to outperform, weakened a little bit, and it's going back. It keeps going back to the leading segment. So it's pretty much showing that this is a strong sector to stay with.
So we can track it like from every quadrant, we can track it down each and every
Yeah,
sector.
and if you see that it's continuously going back to the leading segment in circles, I mean, this is something that's outperforming consistently.
Okay, sir. So that was it, sir. For the questions for today. So let's get to the questions. People, the first question is from Atul.
After this analysis, please make valuation related analysis for long-term investing. So valuation related analysis, Atul, has to be done at a stock specific level. I have explained it in detail how to do it in one of the previous Weekend with India Charts episodes that we do on the weekend on Saturdays. We also taught it on the mentorship program. We may publish ideas based on that at a later point in the year once we have approval to do that. Right now we are not doing that, but it's possible. So we look for stocks that have both momentum and valuation, but because if you're paying a higher value for something, then you want it to have growth. If you're paying a low valuation for something, you want it to be at the end of a business cycle when it's going to start something new. So those are the things we really watch out for, and you can filter it out using these scanning tools on Strike.
So moving to the next question for today.
Can Reliance be a game changer? It's forming a king of head and shoulders, although I know don't follow it much, but I do follow it a lot. Who can't follow Reliance Industries? But pushes above 1400, 1500 will be coming soon. So, I mean, I don't know if you know, I had, in fact, put out a chart of it having maximum highest short positions in the month of December. It continued to form that expanding triangle all the way into April, and then reversed from there. Now, the real question is this rise also has been, see, it's made several corrective moves up and down. We are not licensed to give you a full opinion of where it may head in the future, and which is why probably we are not talking about it much. So you feel that we don't follow it, but it is an important stock from an index point of view. It is one of the drags for the market recently because of all the news around Russia. they are most affected because they buy a lot of the oil from Russia, and they've had to resource it from elsewhere. And still getting that oil in was not easy, because a lot of the shippers were saying, like, yeah, we can't send it because we don't know what's going to happen on the tariff front and so on. That's been one tough thing that people have faced, and a lot of what I'm saying is based on uh, news and news and things that I hear from different channels. I can't say it's verified, but it's impacted the stock. Now, will all that work itself out if Russia and US agree on things, or if the additional duties are not levied? Yeah, that's something we need to see.
Yeah. Hello, sir. Sorry for the delay. There was a network issue, so my voice, I was paused for a while. So that is it for today's questions and answer session. So that's it for today. Let's wrap this session over here. So thank you everyone for joining in, and stay tuned for our next session. And do not forget to go and just have a visit on our www.indiacharts.com. And if you want the entire course starting from beginning to advanced level on Elliott waves and everything in the stock market, you can just have a look on our mentorship program. And also don't forget to have a look on our Strike platform. It's a very, very good, useful tool for you guys. You guys would love it. So RRG is also a USP of ours platform. You can track everything in that. You don't have to hop in from one platform to another for seeking technicals, fundamentals on everything. Everything collaborated in one platform, very beautifully shown. So just have a look. Thank you. Thank you, everyone. Thank you, sir.
Thank you.